There is an asset more valuable than any factory, more durable than any patent, and more powerful than any brand. It is the one asset that can never be fully insured, yet it provides the greatest insurance policy of all. It doesn't appear as a line item on a single balance sheet in the world, yet it is the silent guarantor of every other number on that sheet. This asset is a company's reputation for absolute, unyielding integrity. Its presence is the quiet engine of multi-generational compounding. Its absence is a ticking time bomb, a hidden red flag that predicts with chilling accuracy the probability of a stock going to zero. For decades, investors have scoured the earth for complex formulas, secret algorithms, and proprietary data to gain an edge. They build quantitative models of breathtaking complexity, believing the secrets to wealth are hidden in the numbers. But the greatest investor of our time, Warren Buffett, built his fortune on a far simpler and far more profound truth. He understood that before you can analyze a single number, you must first analyze the character of the people who produce those numbers. He recognized that the most dangerous risk in any investment is not market volatility or economic recession. It is the risk of misplaced trust. Investing in a company run by brilliant, energetic people who lack integrity is like handing a lit match to an arsonist in a fireworks factory. The explosion is not a matter of if, but when. And when it comes, it is total. It is a permanent loss of capital from which there is no recovery. This is not a lesson about morality. This is a cold, hard lesson in financial survival. It is about understanding that trust is not a soft skill. It is a financial metric. Integrity is not a virtue. It is the ultimate competitive advantage. What you are about to learn is a system of thinking, a mental framework that will transform your approach to the market. You will learn to see beyond the seductive allure of quarterly earnings and discover the foundational bedrock of long-term value. You will learn to perform a new kind of due diligence, a due diligence of character. You will add the single most important question to your investment checklist. Are these people honest? By making corporate integrity a non-negotiable black and white criterion for every dollar you invest, you will build a fortress around your portfolio. You will not only sidestep the catastrophic scandals that wipe out the uninformed, you will align yourself with the unstoppable force of compounding trust, the single greatest engine of wealth the world has ever known. This is the final promise that separates the amateur from the professional, the speculator from the owner. And it begins now. The journey into this powerful mindset starts with a single foundational idea, that a company's reputation is not merely an intangible concept, it is a form of capital. It is an asset, as real and as vital as cash in the bank or machinery on a factory floor. In fact, it is superior to both, because it is the one asset that is truly uninsurable. You can insure a factory against fire, a shipment against loss, but there is no insurance policy you can buy to restore the trust of millions of customers once it has been shattered. The story that best illustrates this concept, the crucible, in which this idea was forged into a core tenet of the Buffett philosophy, takes us back to a pivotal moment in American financial history. It's the story of the Great Salad Oil Scandal of 1963. The setting is Bayonne, New Jersey. The protagonist of the fraud is a man named Anthony Tino DeAngelis, a charismatic, larger-than-life commodities trader. His company, Allied Crude Vegetable Oil, was in the business of selling salad oil, lots of it. He borrowed immense sums of money from banks and financial institutions, using his vast inventory of salad oil as collateral. The lenders, including a warehousing subsidiary of the Great American Express, held warehouse receipts that certified they had a claim on millions of pounds of valuable oil stored in DeAngelis's tanks. The problem was, the oil wasn't there. DeAngelis had devised a brilliant and simple scam. Since oil is lighter than water, he filled his giant storage tanks mostly with seawater, with only a few feet of salad oil floating on top. When inspectors came to check the inventory, they would dip their measuring sticks into the tanks and see pure, valuable oil. The fraud was epic in scale. DeAngelis claimed to have over 1.8 billion pounds of salad oil, a quantity so vast it exceeded the entire country's official supply. In November 1963, The house of cards collapsed. Allied Crude defaulted on its loans, the truth came out, and the company went bankrupt. The fallout was immediate and catastrophic. Wall Street was thrown into chaos. Dozens of brokerage houses failed. But the biggest victim appeared to be American Express. Its warehousing subsidiary was on the hook for over $60 million in worthless warehouse receipts, a staggering sum at the time, equivalent to nearly $500 million today. Panic erupted. The market assumed American Express was ruined. How could this blue-chip institution have been so easily duped? If they were this incompetent in their warehousing division, surely the rot must run through the entire company. The stock, a darling of Wall Street, plummeted. It fell by nearly 50% in a matter of weeks. The consensus view was clear: sell, get out before it goes to zero. This was a classic crisis of confidence, a complete shattering of trust. And in this moment of maximum fear and pessimism, a 33-year-old Warren Buffett saw not a disaster, but the opportunity of a lifetime. While others were reacting to headlines, Buffett was doing the work. He understood that the market was confusing the value of one small, flawed subsidiary with the value of the entire American Express enterprise. He decided to conduct his own form of due diligence, not by looking at spreadsheets, but by investigating the company's core reputational asset. He went out into the real world. He visited restaurants and banks in his hometown of Omaha. He would sit at a diner and watch people pay for their meals. Did they pull out an American Express card? He would stand in line at the bank and observe customers buying travelers' checks. Did they still ask for American Express by name? He spoke to travel agents, to hotel clerks, to everyone who dealt with the core American Express products. What he discovered was that the salad oil scandal, while a massive story on Wall Street, was barely a blip on the radar of the average customer. People's trust in the American Express brand, the core promise that its card would be honored and its travelers' checks would be as good as cash anywhere in the world, was completely unshaken. The scandal had damaged a branch of the company, but the roots, the deep cultural trust built over decades, were perfectly intact. He realized that this trust, this reputation, was the company's true uninsurable asset. It was the source of its pricing power and its customer loyalty. The warehousing division was a mistake, a costly one, but it was not the business. The real business was the global franchise of trust. Based on this insight, Buffett made one of the boldest moves of his early career. He invested 40% of his partnership's capital, a massive, concentrated bet, into American Express stock. Over the next few years, as the company dealt with the scandal's fallout and the strength of its core business reasserted itself, the stock price soared. Buffett's partnerships made a fortune. This single investment was a masterclass in separating temporary problems from permanent impairments, and in understanding that the most valuable asset a company owns is the faith of its customers. The American Express saga reveals a deep psychological principle that governs markets and human behavior: the power of the halo effect and its dark twin, the horns effect. The halo effect is a cognitive bias where our overall impression of a person, brand, or company influences our feelings and thoughts about their specific traits. For decades, American Express had meticulously built a halo of prestige, security, and reliability. When you saw the blue box logo, you didn't just see a payment method, you saw a symbol of financial integrity. This halo created a powerful, cognitive shortcut for millions of people. It saved them the mental energy of having to reevaluate the company's trustworthiness every time they made a transaction. They simply trusted it. This trust is an economic lubricant. It makes business flow faster, cheaper, and more efficiently. When the salad oil scandal hit, Wall Street analysts and investors experienced the opposite phenomenon: the horns effect. The incompetence and fraud discovered in one division cast a dark shadow, or horns, over the entire organization. Suddenly, every part of the business was viewed with suspicion. The halo of trust was shattered. and replaced by a cloud of doubt. This is why stock prices react so violently to integrity-based scandals. The decline isn't a rational repricing based on the direct financial cost of the scandal itself. The $60 million loss for American Express, while large, was not an existential threat. The 50% drop in market capitalization represented a far greater loss, a loss driven by the market's fear that the uninsurable asset, the company's reputation, had been permanently destroyed. What Buffett uniquely understood was that the halo effect was still firmly in place where it mattered most, with the end customers. His on-the-ground research confirmed that the halo had not been broken in the minds of the millions of people who used the cards and checks. He saw that Wall Street was suffering from the horns effect, while Main Street was still basking in the glow of the halo effect. This disconnect between perception and reality was where the immense opportunity lay. Understanding this psychological dynamic is critical for every retail investor. Companies with a strong, long-standing reputation for integrity benefit from a persistent halo effect. They get the benefit of the doubt from customers when a product fails. They get favorable terms from suppliers who trust they will be paid. They attract the best talent because people want to work for a company they can be proud of. And crucially, they often get a pass from regulators on minor infractions. This halo is a powerful economic moat that protects shareholder value. Conversely, a company that shatters its reputation suffers from a persistent horns effect. Every move is scrutinized. Every earnings report is doubted. They face higher borrowing costs, customer boycotts, and intense regulatory pressure. The business is forced to operate with a constant headwind, a tax on every transaction, a distrust discount applied to its stock price. This is why avoiding companies with questionable integrity is the ultimate form of risk management. You are not just avoiding a single bad event. You are avoiding the crippling long-term economic consequences of the horns effect. So how do we, as individual investors, translate this profound idea into a practical, repeatable process? How do we build an investment checklist that allows us to audit a company's most critical asset? We can create what I call the reputational moat audit. This is a mental model, a blueprint for looking beyond the numbers and assessing the quality and durability of a company's integrity. It consists of 5 distinct steps. Step 1 is to map the trust network. Every business sits at the center of a web of relationships: customers, employees, suppliers, regulators, and the community in which it operates. A company with true integrity nurtures all of these relationships. Before investing, ask yourself, how does this company treat each of these stakeholders? Does it have a history of squeezing its suppliers to the breaking point? Does it have a long record of labor disputes and poor employee morale? Does it constantly battle regulators? A weakness in any one of these trust relationships is a potential point of failure for the entire enterprise. A company that abuses its suppliers today will likely find a way to mislead its investors tomorrow. Step 2 is to analyze the language. The words a company's leadership uses are a direct window into its culture and priorities. Your task is to become a forensic linguist. Go back and read the last 10 years of shareholder letters. Scour the transcripts of earnings calls. Watch interviews with the CEO. Are they speaking in clear, simple language, or are they hiding behind corporate jargon and complex acronyms? Buffett famously loves CEOs who write as if they are talking to their sisters, assuming they are intelligent but not experts in the industry. More importantly, listen for accountability. When the company inevitably hits a rough patch, does the CEO take direct responsibility, explain what went wrong, and outline the steps to fix it? Or do they blame the economy, the competition, the weather? Anything but their own decisions. A culture of blame is a massive red flag. A culture of candid accountability, even when it's painful, is a sign of immense strength. This CEO analysis is a core competency of value investing. Step 3 is the Glassdoor test. While shareholder letters give you the official story, platforms like Glassdoor can give you the unofficial, ground truth reality from current and former employees. Do not look for a perfect score. Every large company will have disgruntled employees. Instead, look for patterns. Are the negative reviews consistently pointing to a high-pressure sales culture that encourages cutting corners? Do they describe a leadership team that is out of touch or that penalizes honest feedback? Is there a recurring theme of ethical lapses being ignored? A toxic internal culture is like a cancer. It may not be visible on the surface of the financial statements for years, but it is slowly eating away at the company from the inside, getting ready to metastasize into a full-blown public scandal. Good corporate governance starts with how you treat your own people. Step 4 is the customer outrage test. Every company that sells a product or service will eventually make a mistake. A product will be defective. A service will fail. The moment of failure is a moment of truth. It's a test of the company's character. How do they react? Do they try to hide the problem, deny it, or downplay its severity? Or do they immediately go public, take ownership, over-communicate with their customers, and make it right, even if it's incredibly expensive in the short term? Think of Johnson & Johnson's handling of the Tylenol poisoning crisis in 1982. Their swift, decisive, and costly recall of all products cemented their reputation for decades. Now contrast that with companies that drag their feet on safety recalls. The former builds the reputational moat wider and deeper. The latter fills it with alligators. As an investor, you should actively seek out stories of how a company has handled its biggest mistakes. The past is a powerful predictor of the future. Finally, step 5 is to create a regulatory scrutiny score. While some industries are naturally more regulated than others, a pattern of consistent fines, investigations, and sanctions is a clear warning sign. Go to the websites of the relevant regulatory bodies, the SEC, the EPA, the FDA, and search for the company's name. Are they a repeat offender? Are the fines getting larger over time? This isn't just about the financial cost of the fines themselves, it's about what it says about the company's culture. A company that views regulations as obstacles to be circumvented rather than as rules designed to protect the public has a fundamental character flaw. That flaw will eventually manifest in other areas of the business, exposing shareholders to catastrophic risk. This meticulous, qualitative approach stands in stark contrast to the path followed by the 99% of investors. The vast majority of market participants are trapped in what can only be described as the spreadsheet trap. They believe that the more complex their financial model, the more precise their understanding of a business. They spend hundreds of hours building intricate spreadsheets that project revenues, costs, and cash flows out to 10 decimal places. They debate endlessly about whether the correct terminal growth rate is 2.5% or 2.7%. They are seduced by the illusion of precision, the false comfort that comes from having a single definitive number spit out by their model. The problem is that these models are, by their very nature, blind to the single most important variable, the risk of fraud or catastrophic reputational collapse. There is no cell in a spreadsheet for management integrity score. You cannot quantify corporate culture as a percentage of revenue, and so, because it cannot be easily quantified, it is ignored. This is how a company like Valeant Pharmaceuticals was able to fool so many supposedly sophisticated investors for so long. On the spreadsheet, Valeant looked like a miracle. Its revenue and earnings per share were growing at an astonishing rate. Its CEO, Michael Pearson, was celebrated on the cover of magazines as a management genius. The spreadsheet jockeys loved it. The numbers were undeniable, but they were ignoring the fundamental reality of the business. Valeant's growth was not coming from innovation or operational excellence. It was built on a morally bankrupt and ultimately unsustainable strategy, acquiring pharmaceutical companies that produced life-saving drugs, firing their research staff, and then jacking up the prices by hundreds or even thousands of %. They coupled this with a secret network of specialty pharmacies to push their high-priced drugs and obscure their tactics. Any investor who applied the reputational moat audit would have seen the red flags instantly. Mapping the trust network would have revealed a company that was despised by patients, doctors, and regulators. Analyzing the language would have revealed a management team obsessed with financial engineering and deal-making, with little mention of science or patient outcomes. The Glassdoor test would have shown a brutal, high-pressure culture. The regulatory scrutiny score would have been off the charts as politicians and prosecutors began to circle. The business model itself was a massive integrity risk. It was predicated on a bet that they could exploit the most vulnerable people in society without facing a backlash. It was a bet they were destined to lose. When the truth was finally exposed, the collapse was swift and total. The stock fell by over 95%, wiping out tens of billions of dollars in shareholder value. The complex spreadsheets that had predicted years of glorious growth were revealed to be worthless works of fiction. The 99% were trapped because they looked only at the numbers. The savvy investor, the one who understood Buffett's principle, would have taken one look at the business model and walked away, not because of a bad number, but because of a bad character. The financial connection between a company's integrity and its bottom line is not abstract. It is direct, powerful, and quantifiable, even if it doesn't appear on the balance sheet. A strong reputation is a cash-generating machine. Think about it from a purely economic standpoint. First, it dramatically lowers customer acquisition costs. A company with a stellar reputation like Costco or Apple benefits from an army of unpaid marketers, its own delighted customers. Word of mouth is the most effective and cheapest form of advertising. Conversely, a company with a tarnished reputation, like many cable or airline companies, must spend enormous sums on advertising just to tread water, constantly battling customer churn. Second, integrity increases customer lifetime value. When customers trust you, they are more loyal, they are less price-sensitive, they are more willing to try your new products. This creates a stable, recurring revenue stream that is the holy grail of any business. A scandal shatters this loyalty overnight, forcing the company to compete on price alone, a brutal, low-margin existence. Third, a reputation for integrity attracts and retains top talent. The most skilled and motivated employees have a choice of where to work. They want to be part of a mission they believe in, a culture they respect. This allows high-integrity companies to hire the best people while spending less on recruitment. It also reduces costly employee turnover. A toxic culture leads to a constant brain drain, as the best people are the first to leave, leaving behind a demoralized and less effective workforce. Fourth, a strong reputation provides critical regulatory leeway. When a trusted company makes a mistake, regulators are often inclined to give them the benefit of the doubt, to work with them to fix the problem. They have earned a reservoir of goodwill. A company with a history of cutting corners is shown no such mercy. They are met with suspicion, skepticism, and the full force of the law. This translates into higher legal fees, larger fines, and more onerous operating restrictions. Finally, and perhaps most importantly, integrity lowers the cost of capital. Banks, lenders, and partners are far more willing to do business with a company they trust. This results in lower interest rates on loans, better terms from suppliers, and more attractive partnership opportunities. When a company is engulfed in scandal, the opposite happens. Lenders call in their loans, suppliers demand cash on delivery, and potential partners run for the hills. This can trigger a sudden liquidity crisis, a corporate death spiral from which it is very difficult to recover. The stock price, in the end, is just a reflection of all these underlying economic realities. A drop in stock price after a scandal is not an irrational panic. It is the market rapidly and brutally repricing the business for a future with higher costs, lower revenues, and greater uncertainty. The shareholder value that is lost is not imaginary. It is the direct financial consequence of destroying the one asset that can never be bought back at any price: trust. If the American Express saga was the case study in identifying a durable reputational asset, then the Salomon Brothers scandal of 1991 was Warren Buffett's trial by fire. It was the moment he was forced to step out of the comfortable role of a passive investor and take the controls of a burning airplane, armed with nothing but his own reputation and an unshakable belief in the paramount importance of integrity. This was not a theoretical exercise. It was a real-world crisis that threatened to bring down one of the largest firms on Wall Street and posed a systemic risk to the entire financial system. Salomon Brothers in the late 1980s was the undisputed king of the bond market. They were brash, aggressive, and enormously profitable. Buffett, through Berkshire Hathaway, had become their largest shareholder, investing $700 million in preferred stock. He was attracted by their dominant market position, but he was always wary of their culture, a hyper-competitive environment famously depicted in the book Liar's Poker. In August 1991, his worst fears were realized. The firm publicly admitted that one of its top traders, a man named Paul Moser, had been systematically breaking the rules in the U.S. Treasury bond auctions. The Treasury had rules limiting any single firm to bidding for no more than 35% of the bonds in a given auction. Moser, in an act of breathtaking arrogance, had not only submitted bids for Salomon's maximum allowable share, but had also submitted unauthorized bids in the names of some of Salomon's clients to corner the market. This was not just a minor infraction. This was a direct fraud against the United States government. The initial revelation was bad enough. But what turned a serious problem into a corporate life-or-death crisis was the handling of it by Salomon's top leadership, CEO John Gutfreund and his lieutenants. It was discovered that they had known about Moser's transgressions for months. They had confronted him, but they hadn't fired him, and crucially, they hadn't informed the regulators. They had sat on a ticking time bomb, hoping it would just go away. When the full truth came out, all hell broke loose. The market was terrified. Salomon's business depended on its ability to trade with the U.S. Treasury. If the government, as was widely expected, barred them from the auctions, or, even worse, brought a criminal indictment against the firm, it would be a death sentence. The firm's clients fled, its funding dried up, and it was teetering on the brink of collapse within days. This is when Buffett got the call. The Treasury Secretary, Nicholas Brady, made it clear that the government had lost all faith in Salomon's management. They were on the verge of being shut down. Buffett, as the largest shareholder and a man of unimpeachable integrity, was the only person who could save the firm. He flew to New York and, in a whirlwind weekend, took control. He forced the resignations of the top management and, reluctantly, agreed to step in as the interim chairman. His task was monumental: to convince the U.S. Treasury, the Federal Reserve, Congress, and the entire global financial market that Salomon Brothers could be saved, that it could be trusted again. His strategy was a masterclass in crisis management, a direct application of his core principles. He knew that the only currency that mattered now was absolute, radical transparency. His first move was to cooperate fully and completely with the authorities. He waived attorney-client privilege. He instructed his people to find every single misdeed, no matter how small, and report it immediately. His most iconic moment came when he was called to testify before a congressional subcommittee. The world was watching. The politicians were ready to tear him apart. Instead of being defensive or evasive, he began his testimony with a statement that has become legendary in the annals of business history. He looked the committee in the eyes and said, "Lose money for the firm, and I will be understanding. Lose a shred of reputation for the firm, and I will be ruthless." In that single sentence, he redefined the culture of the firm. He laid down a new law: profits were secondary, reputation was primary. He went on to describe the new compliance systems he was putting in place, systems designed to catch any wrongdoing instantly. He was candid about the firm's failures, but resolute about its future. He wasn't just fixing a problem. He was performing emergency open-heart surgery on the firm's culture, in public, for the entire world to see. His performance worked. The Treasury, convinced of his sincerity, allowed Salomon to continue trading. The crisis was averted. The firm was saved from immediate collapse. It was a brutal, costly affair, but it survived because one man understood that when your reputation is on fire, the only way to put it out is with a fire hose of truth. The catastrophic failure of Salomon's original leadership can be explained by a powerful cognitive bias known as the commitment and consistency bias. This is our deep-seated psychological need to be consistent with things we have already said or done. Once we make a decision or take a stand, we face personal and interpersonal pressure to behave consistently with that commitment. John Gutfreund and his team were ensnared in this psychological trap. They knew about Paul Moser's rule-breaking months before it became public. Moser was a hugely profitable trader, a big swinging dick in the parlance of the firm, who generated hundreds of millions in revenue. To punish him or report him to regulators would have required them to do several psychologically difficult things. First, it would mean sacrificing those enormous profits. Second, it would mean admitting that their own management and compliance systems had failed. Third, it would mean confronting the reality that the very culture they had fostered, a culture of pushing the envelope and winning at all costs, was responsible for this mess. Having implicitly tolerated Moser's behavior for so long, their brains were wired to continue down that path. To reverse course would be to admit they were wrong, incompetent, and complicit. So they did what most people do when trapped by the commitment bias. They escalated their commitment to the bad decision. They delayed. They rationalized. They hoped the problem would disappear. They told themselves it was a one-time issue, that Moser had been warned, that it wouldn't happen again. This cognitive distortion is incredibly common in corporate life. Leaders become committed to a failing project, a flawed strategy, or a toxic employee, and rather than cut their losses, they double down, throwing good money after bad, because to pull back would be an admission of failure. Warren Buffett, coming in as an outsider, was free from this bias. He had no prior commitment to the decisions that led to the crisis. He wasn't emotionally invested in the old guard or the old way of doing things. He could see the situation with brutal, objective clarity. The firm's reputation was hemorrhaging. The only way to stop the bleeding was to amputate the source of the infection, which meant getting rid of the people who had allowed it to fester. His actions were not clouded by a need to be consistent with past mistakes. He was only concerned with being consistent with his own core principle. That integrity is non-negotiable. This is a profound lesson for every investor engaged in CEO analysis. When you see a management team that is unable to admit a mistake, that consistently doubles down on a failing strategy, you are likely watching the commitment and consistency bias in action. It is a sign of weak, psychologically trapped leadership, and it is a signal to sell, because they are on a path that very rarely leads to a good destination. From Buffett's actions at Salomon, we can distill a powerful mental model for any leader facing a crisis, and for any investor evaluating a company's response to one. I call it the Ruthless Purity Protocol. It is a 4-step blueprint for restoring trust when it has been shattered. Step 1 is immediate, radical transparency. The moment an integrity-based problem is discovered, the leadership has a choice. They can try to manage the narrative, release information slowly, and hope to minimize the damage, the typical corporate playbook. Or they can do what Buffett did: get everything out into the open, immediately. You must assume that the full truth will eventually emerge, and it is far better for it to come from you, voluntarily, than from a whistleblower or an investigative journalist. This approach is painful in the short term. It means admitting the full scope of the failure up front. But it is the only way to cauterize the wound. A slow trickle of bad news, the death by 1,000 cuts, is infinitely more destructive to shareholder value because it creates a state of perpetual uncertainty. And the market hates uncertainty more than anything. Step 2 is to fire the source, not just the symptom. In most corporate scandals, the first move is to find a scapegoat. A mid-level manager or a rogue employee is publicly fired, while the senior leadership who created the culture and oversaw the systems that failed remain in place. This is a red flag for investors. It signals that the board does not truly understand the root cause of the problem. Buffett knew that Paul Moser was just a symptom of a deeper cultural disease at Salomon. To truly cure the firm, the leadership that had tolerated the disease, Gutfreund and his top deputies, had to go. When evaluating a company in crisis, watch the board's actions closely. Do they perform a real house cleaning, or do they just offer up a sacrifice to appease the market? The difference is critical. Step 3 is to publicly recommit to first principles. It is not enough to simply say, "We will fix it." A true leader must use the crisis as an opportunity to publicly and forcefully re-establish the core values of the organization. Buffett's congressional testimony was the ultimate example of this. He didn't just talk about new compliance rules, he talked about right and wrong, he drew a line in the sand. He used powerful, simple moral language to signal a complete break with the past. This act of public recommitment gives employees, customers, and regulators a new banner to rally around. It provides a clear vision for what the company will stand for in the future. Finally, step 4 is to align incentives with integrity. Words are meaningless unless they are backed by action. The final step in the Ruthless Purity Protocol is to fundamentally change the systems and incentives that led to the bad behavior. This means redesigning compensation plans so that they reward long-term ethical value creation, not just short-term profits. It means empowering the compliance and legal departments, giving them real authority and a direct line to the board. It means creating robust whistleblower protections so that employees feel safe to report wrongdoing without fear of retribution. As an investor, you must look for evidence of these concrete changes. A press release full of apologies is worthless. A redesigned compensation structure detailed in the proxy statement is proof of real change. The path of ruthless purity is, unfortunately, the road less traveled. The path of the 99% of companies facing a scandal is the slow bleed of denial. The case of the Wells Fargo account fraud scandal is a textbook example of how not to handle a crisis and the devastating long-term consequences for shareholder value. The scandal, which began to surface in 2016, revealed that for years, bank employees had been secretly creating millions of unauthorized bank and credit card accounts in the names of their customers in order to meet impossibly aggressive sales quotas. This was not the action of a few rogue employees. It was a systemic problem driven by a toxic, high-pressure sales culture that was baked into the bank's DNA. The company's response was a perfect illustration of the slow bleed. Initially, the leadership downplayed the problem. The CEO at the time, John Stumpf, tried to frame it as the fault of a small number of low-level employees who had failed to honor the company's values. He was defensive and, in his testimony before Congress, appeared woefully out of touch with the reality of the culture he had presided over. There was no radical transparency. Instead, the full scope of the misconduct came out in a slow, painful drip over several years. First, it was 2 million fake accounts. Then it was 3.5 million. Then other scandals emerged. Improper fees in their auto loan business, unnecessary insurance policies, and more. With each new revelation, the company's credibility sank further. They did not fire the source, only the symptoms. While thousands of low-level employees were fired, the senior executive in charge of the division, where the fraud was rampant, Kerry Tolstead, was allowed to retire with a golden parachute worth over $100 million. It was only after immense public and political pressure that the board finally clawed back some of that compensation. There was no clear, forceful recommitment to first principles. Instead, there was a series of mealy-mouthed apologies and a clumsy rebranding campaign. The incentives were not fundamentally changed for years. The response was reactive, defensive, and always one step behind the next damaging headline. The financial consequences of this approach were catastrophic. While Buffett's swift action at Salomon saved the firm and allowed it to eventually recover and be sold at a premium, Wells Fargo's slow bleed has inflicted a decade of pain on its shareholders. The company has paid billions in fines. It has been subject to an unprecedented asset cap by the Federal Reserve, severely limiting its ability to grow. And its stock has been a dramatic underperformer, lagging its banking peers by a massive margin for years. The brand has been permanently tarnished. The trust that took over a century to build was shattered, not just by the original sin, but by the disastrously dishonest way it was handled. This is the path of the 99%, and it is a path to the permanent impairment of shareholder value. When a company chooses the path of denial and the slow bleed, it begins to pay a hidden but very real scandal tax. This tax is not levied by any government, but by the market itself, and it has several components that can be directly observed and quantified. The first and most obvious component is the direct cost of legal and compliance. This includes the billions of dollars in fines paid to regulators, the cost of settling class action lawsuits from customers and shareholders, and the massive fees paid to outside law firms and consultants hired to clean up the mess. For a company like Wells Fargo, these costs have run into the tens of billions of dollars, a direct transfer of wealth from shareholders to the legal system. The second component is an increased cost of capital. The market and lenders are not stupid. When a company is perceived as untrustworthy or poorly managed, its risk profile increases. Bond rating agencies may downgrade its debt, forcing it to pay higher interest rates on any new bonds it issues. Banks will charge more for loans. This increases the company's interest expense forever, permanently reducing its future profitability. The third and perhaps largest component is brand impairment. Brand valuation is a complex field, but there are methodologies that attempt to place a dollar value on a brand. After a major scandal, the value of a company's brand plummets. This is not an abstract concept. It translates into a measurable drop in customer trust, leading to lower sales and a loss of market share as customers flee to more trusted competitors. Rebuilding that brand requires hundreds of millions of dollars in advertising, with no guarantee of success. A fourth component is the talent drain. In the modern economy, a company's most valuable assets are its people. When a company is mired in scandal, the best people, the ones with the most integrity and the most career options, are the first to head for the exits. They don't want their personal reputations tarnished by association. This creates a vicious cycle. The company is left with a demoralized workforce. It has to pay more to attract new talent, and it suffers from a loss of institutional knowledge and innovation. Finally, all of these factors culminate in a permanent valuation multiple compression. The stock market values companies based on a multiple of their earnings or cash flows, like a P/E ratio. This multiple is, in essence, a measure of the market's confidence in the quality and predictability of those future earnings. A company with a strong reputation for integrity and good corporate governance will command a high multiple. A company tainted by scandal will be assigned a permanent distrust discount. Even if it manages to restore its earnings, the market will never value those earnings as highly as it did before. This multiple compression is a direct and permanent reduction in shareholder value. The scandal tax is the ultimate financial manifestation of a reputation in ruins. It is the price companies pay for losing the one asset that is truly priceless. Having explored the catastrophic consequences of integrity failures, we must now turn to the other side of the coin, the immense value created by proactively investing in exceptional management. Buffett's philosophy isn't just about avoiding the bad guys. It's about concentrating your capital with the great ones. His most famous principle is that he looks for three things in a manager: integrity, intelligence, and energy, and he warns that if they don't have the first, the other two will kill you. A brilliant, energetic crook will simply find more clever and faster ways to ruin the company. The story that perfectly embodies this positive principle, the search for unimpeachable integrity, is the story of his purchase of the Nebraska Furniture Mart from its legendary founder, Rose Blumkin, better known as Mrs. B. This was not a billion-dollar Wall Street deal. It was a transaction rooted in decades of observation and a profound trust in character. Mrs. B's life story is the stuff of American legend. She was a Russian immigrant who fled persecution, arriving in America in 1917, unable to speak a word of English. She settled in Omaha, Nebraska, and in 1937, with a loan of $500, she started a small furniture store in a basement. Her business philosophy was radical in its simplicity: sell cheap and tell the truth. She worked tirelessly, undercutting her established competitors who were colluding to keep prices high. She built her business not on slick advertising but on a fanatical devotion to her customers and an ironclad reputation for honesty. If she told you a rug was a certain quality, it was. If she promised the lowest price, she delivered. Over the decades, she built the Nebraska Furniture Mart into a retail behemoth, the largest home furnishing store in North America, a massive Omaha landmark that drew customers from hundreds of miles away. Warren Buffett had watched her for years. He was a customer. He saw her business acumen, her energy, and most importantly, her absolute, unwavering integrity. She was the personification of an owner-operator who treated her customers, money as if it were her own. In 1983, Buffett decided he wanted to buy the company. The negotiation was unlike any other in corporate history. He went to see the 89-year-old Mrs. B. He asked her how much she wanted. She named a price. He said, "Done." The entire deal was sealed with a handshake and a simple 2-page contract written by Buffett himself. There was no army of investment bankers. There were no teams of lawyers conducting months of due diligence. Crucially, Buffett did not demand an audit of the company's books. When an associate asked him why he wasn't auditing the financials, Buffett's response was a masterclass in his own philosophy. He said, "Mrs. B has been telling me the truth for 50 years. I would be insulting her to have an auditor check whether she was telling me the truth now." He understood that with a person of Mrs. B's character, the formal process of due diligence was secondary. Her character, true, was the due diligence. He knew she would never cheat him, because she had never cheated a single one of her customers. He was not just buying a collection of buildings and inventory. He was buying a culture of trust that had been built, brick by brick, over half a century. The acquisition was a phenomenal success for Berkshire Hathaway. Mrs. B and her family continued to run the business with the same integrity and passion, growing it into an even larger and more profitable enterprise. The story of the Nebraska Furniture Mart is the perfect counterpoint to the Salomon Brothers scandal. It demonstrates that the ultimate goal of due diligence is not to verify numbers, but to verify character. When you find a manager with the absolute integrity of a Rose Blumkin, you have found the greatest, most durable, and most profitable asset in the entire world of business. This focus on the character of management is Buffett's brilliant solution to one of the most persistent and destructive problems in modern capitalism, the principal-agent problem. This is a core concept in economics and corporate governance. In any public company, the shareholders are the owners, the principals, but they don't run the company day to day. For that, they hire executives, the CEO and their team, to act as their agents. The problem is that the interests of the agents are not always perfectly aligned with the interests of the principals. A shareholder wants to see the long-term, sustainable maximization of the company's intrinsic value. An agent, however, might have different goals. The agent might be motivated by the size of their annual bonus, which could incentivize them to cut corners to make quarterly numbers. They might be motivated by empire building, leading them to make foolish, overpriced acquisitions just to increase the size of the company they command. They might be motivated by a desire to avoid risk and difficult decisions, leading to stagnation. They might use the company's money to fund a lavish lifestyle of corporate jets and extravagant perks. This misalignment of interests is a constant drag on shareholder value. It's a tax that principals pay for having to trust agents. Buffett's entire approach to CEO analysis is designed to short-circuit this problem. By making integrity the #1 criterion, he is not looking for a hired gun, an agent. He is looking for a partner, a steward, someone who has the psychological makeup of a principal. He seeks out managers who think and act like owners, regardless of their official title. These are people who have an innate internal drive to do the right thing for the business over the long haul. They are not motivated by their next bonus, but by a deep-seated pride in the institution they are building. They are careful with the company's money because they see it as their own. They are candid about problems because they see shareholders as partners who deserve the truth. When you invest in a company run by a manager with this owner's mindset, the principal-agent problem virtually disappears. You are no longer betting on a hired hand, you are betting on a fellow owner. Your interests are naturally and powerfully aligned. This dramatically reduces the hidden risks of investing in a public company. It eliminates the need to constantly worry about whether management is serving itself or serving you. This is why Buffett can buy a multi-billion-dollar business with a handshake. He is not just assessing a manager's intelligence or energy, he is assessing whether they belong in the category of agent or principal. Finding a true principal is so rare and so valuable that it transcends almost every other investment metric. How can a retail investor, without the benefit of a personal meeting with a CEO, apply this principle? You can create a practical investment checklist, a 3-bucket management audit, to systematically evaluate the quality of a company's leadership from afar. The first bucket is the integrity bucket. This is the non-negotiable foundation. Your first check is the track record. Do a deep dive into the CEO's history. Have they ever been associated with a company that had an accounting scandal? Have they been involved in questionable personal or professional dealings? The internet has made this research easier than ever. A pattern of behavior is a powerful clue. Next, analyze their language for candor. Read their annual letters to shareholders with a critical eye. Buffett famously said the first thing he reads is the "what went wrong" section. Does the CEO openly and honestly discuss the company's mistakes and what they learned from them? Or is the letter a glossy marketing document full of corporate platitudes? A leader who cannot admit error is a leader who cannot learn. Finally, examine their capital allocation decisions. Capital allocation is the CEO's most important job. What they do with the company's profits determines its future. Do they repurchase shares when the stock is undervalued, which is a tax-efficient way to reward shareholders? Or do they buy back stock at market highs, often just to prop up the stock price and their own options? Do they make smart, bolt-on acquisitions within their circle of competence? Or do they engage in diversification, paying huge premiums for companies and industries they don't understand? A CEO's capital allocation record is a direct reflection of their rationality and their commitment to shareholder value. The second bucket is the intelligence bucket. This is not about IQ scores or fancy degrees. It is about a specific kind of business intelligence. First, look for deep industry knowledge. When you listen to the CEO on an earnings call or in an interview, do they speak with passion and fluency about the nuts and bolts of their business, the products, the customers, the competitive landscape, or do they retreat into vague financial jargon? A great CEO can explain their business model with such clarity that a reasonably intelligent person can understand it. Complexity is often a cloak for mediocrity or even fraud. Second, look for signs of rationality and independent thinking. Does the CEO have a history of zigging when the rest of the industry was zagging? Did they avoid a foolish trend that their competitors all chased? A herd mentality is the enemy of long-term value creation. You want a leader who makes decisions based on logic and evidence, not on what is popular on Wall Street. The third and final bucket is the energy bucket. Integrity and intelligence are useless without a powerful drive to put them into action. First, look for an owner's mentality. Does the CEO have a significant portion of their own net worth invested in the company's stock? Do they buy stock with their own money on the open market? When a leader has their own skin in the game, their interests are profoundly aligned with yours. Second, look for a long-term vision. Does the CEO articulate a clear and compelling picture of where the company is going over the next 5, 10, or even 20 years? Or are they hyper-focused on hitting the next quarterly earnings target? Great leaders are builders, and builders think in terms of decades, not quarters. Finally, listen for genuine passion. Is this just a job for the CEO, or is it their life's work? You can often sense this. Passion is the fuel that drives a leader through the inevitable tough times. A passionate leader can inspire an entire organization to achieve greatness. A CEO who passes the test in all three of these buckets, integrity, intelligence, and energy, is a rare find. But when you find one, you have dramatically increased your odds of investment success. The meticulous, character-focused approach of the three-bucket audit is the polar opposite of one of the most common and dangerous traps in investing: the cult of the rock star CEO. The market has a dangerous tendency to fall in love with charismatic, visionary leaders who are masters of storytelling but may lack the operational discipline or ethical grounding to build a sustainable business. These rock star CEOs often grace the covers of magazines, give captivating TED Talks, and build a powerful reality distortion field around themselves and their companies. Investors, caught up in the narrative and driven by a powerful fear of missing out, abandon all normal standards of due diligence. They invest in the story, not the substance. The recent history of the market is littered with the wreckage of these cults. Adam Neumann of WeWork was a master storyteller. He sold a vision of elevating the world's consciousness through shared office space. Investors, including some of the most sophisticated venture capitalists in the world, poured billions of dollars into his company, ignoring the glaring red flags: the nonsensical business model that lost more money the more it grew, the abysmal corporate governance, and Neumann's erratic personal behavior. They were invested in the messianic charisma of the leader, not the economics of the business. When the company tried to go public, the harsh light of financial scrutiny caused the entire house of cards to collapse, destroying billions in value. Elizabeth Holmes of Theranos was another charismatic visionary. She adopted the black turtleneck of Steve Jobs and sold a compelling story of revolutionizing healthcare with a single drop of blood. The narrative was so powerful that it attracted a star-studded board of directors and hundreds of millions in investment. But the technology never worked. The entire enterprise was a massive fraud. Investors who were mesmerized by the rockstar CEO failed to ask the most basic questions of due diligence. They were seduced by the vision and the personality. This is a recurring pattern. The 99% of investors are susceptible to a good story. They mistake charisma for competence and a grand vision for a viable business plan. A truly disciplined investor learns to be immune to this siren song. They listen to the story, but then they turn off the microphone and do the hard, boring work of the three-bucket audit. They are skeptics by nature. They trust, but they verify. They know that the most captivating stories often have the most tragic endings for investors. Avoiding the cult of the rockstar CEO is a critical survival skill for any retail investor looking to achieve long-term portfolio protection. The direct financial connection of finding a manager who embodies integrity, intelligence, and energy is the management premium. The market is reasonably efficient at pricing a company's current assets and earnings, but it is notoriously bad at pricing the qualitative long-term value of exceptional management. A company led by a brilliant high-integrity capital allocator deserves to trade at a higher valuation multiple than a similar company run by a mediocre manager. Why? Because $1 of retained earnings in the hands of the great manager is worth far more than $1 in the hands of the average one. The great manager will take that dollar and reinvest it at a consistently high rate of return for many, many years to come. The mediocre manager will likely squander it on a foolish acquisition or a low-return project. This difference in capital allocation skill, compounded over a decade or two, leads to a staggering divergence in the ultimate intrinsic value of the two businesses. The market, with its obsessive focus on the next quarter's earnings, often fails to properly price this divergence. It underappreciates the long-term compounding power of a great manager and overestimates the prospects of a company run by a charismatic but ineffective one. This creates an opportunity for the patient, diligent investor. By focusing your research on identifying these rare, high-quality leaders, you can buy into businesses whose future earnings power is systematically undervalued by the market. You are essentially getting the skill of a world-class capital allocator for free, or at least at a significant discount. This management premium is not a theoretical concept. It is the secret sauce behind the long-term success of Berkshire Hathaway. Buffett didn't just buy good companies. He bought good companies run by great people, and then he let them work their magic for decades. The compounding of their skill is what created the astonishing returns. As an individual investor, making the three-bucket audit the absolute centerpiece of your investment process is how you can tilt the odds dramatically in your favor. It allows you to move beyond the crowded, noisy world of short-term speculation and into the quieter, more profitable world of long-term ownership in businesses guided by the best hands in the world. To truly understand why the principle of integrity is so paramount, we must confront a difficult truth. For extended periods, the market often appears to reward bad behavior. It celebrates the shortcuts, applauds the ruthlessness, and enriches the executives who prioritize quarterly numbers above all else. This creates a powerful and dangerous allure, tempting both managers and investors to believe that cutting corners is the fastest path to wealth. The story of Chainsaw Al Dunlap is the ultimate cautionary tale of this phenomenon. In the mid-1990s, Al Dunlap was one of the most famous and celebrated CEOs in America. He had earned his nickname and his fearsome reputation at Scott Paper, where he took over as CEO and, in a whirlwind 19 months, laid off 11,000 employees, closed factories, and sold off assets. Wall Street loved him. The stock price of Scott Paper tripled, and Dunlap walked away with a $100 million payday when the company was sold to Kimberly-Clark. He was hailed as a hero of shareholder value, a tough, no-nonsense executive who knew how to unlock hidden profits. He became a corporate celebrity, writing a best-selling book and appearing constantly on television. In 1996, he was hired to work his magic at Sunbeam, a struggling manufacturer of small home appliances. He arrived with his usual bravado, promising a swift and dramatic turnaround. He immediately announced the firing of half the company's 12,000 employees. The market cheered, and Sunbeam's stock soared on the news. The first few quarters under Dunlap's leadership looked miraculous. Sales and profits surged. Analysts upgraded the stock, and institutional investors piled in. Al Dunlap seemed to be delivering on his promise. But beneath the surface, a rot was setting in. Dunlap's methods were not based on operational genius. They were based on a foundation of accounting fraud and a culture of fear. To create the illusion of a turnaround, he used every trick in the book. He engaged in massive, quote, channel stuffing, forcing retailers to buy far more inventory than they could possibly sell by offering huge discounts, effectively pulling future sales into the present. He booked revenue for products that were still sitting in warehouses. He used cookie jar reserves to smooth earnings. He ran the company like a dictator, terrorizing his employees and firing anyone who dared to question his methods. The market, obsessed with the short-term results, ignored the clear warning signs. The financial media celebrated his tough guy persona. For a brief period, the shortcuts seemed to be working brilliantly. But a business built on lies is a house of cards. Eventually, you run out of future sales to pull forward. You run out of accounting tricks to play. In 1998, the truth began to emerge. The company had to announce that its spectacular results were a fiction. The SEC launched an investigation. The stock collapsed, falling from over $50 a share to just a few dollars, and eventually, the company was forced into bankruptcy. Al Dunlap was fired and later barred by the SEC from serving as an officer of a public company. Tens of thousands of employees lost their jobs, and shareholders lost everything. The story of Chainsaw Al is a vital lesson. The market can be fooled. It can be seduced by a good story and impressive, albeit fake, numbers. But reality always wins in the end. The shortcut is always a dead end. And the investors who chase the shortcut are the ones who end up paying the ultimate price, the permanent and total loss of their capital. The market's tendency to reward short-term bad behavior is not an accident. It is a direct consequence of two powerful psychological biases that are hardwired into our brains: hyperbolic discounting and herd behavior. Hyperbolic discounting is the fancy term for a simple human trait. We have a strong preference for a smaller, immediate reward over a larger, delayed reward. We would rather have one cookie right now than 2 cookies in an hour. This bias is exploited by credit card companies, fast food restaurants, and, most profoundly, by Wall Street. The entire ecosystem of the stock market, the quarterly earnings reports, the 24/7 financial news cycle, the analyst price targets, is a massive engine designed to focus our attention on the immediate. CEOs have their bonuses tied to this quarter's earnings per share. Fund managers are judged on this quarter's performance. This creates immense pressure to deliver good news right now, even if it comes at the expense of the long-term health of the business. Al Dunlap was a master at feeding this beast. He knew that by using accounting tricks to manufacture spectacular short-term results, he could trigger a feeding frenzy. This is where the second bias, herd behavior, kicks in. Humans are social creatures. We feel a sense of safety and validation when we are doing what everyone else is doing. In the market, this translates into a powerful fear of missing out. When a stock like Sunbeam starts to take off, a cascade begins. One analyst upgrades the stock. A well-known fund manager announces they have bought a position. The financial news channels start talking about the incredible turnaround story. Soon, individual investors, fearing they will be left behind, start piling in. They are not making a rational decision based on their own research. They are simply following the herd. This creates a positive feedback loop. The more people who buy, the higher the stock price goes, which in turn attracts even more buyers, validating the initial decision of the early members of the herd. This psychological dynamic is how bubbles are born. The bubble around Sunbeam was not built on a foundation of real business improvement, but on a foundation of fraud, amplified by the psychological biases of a market hungry for a good story and terrified of being left out. The eventual collapse is not a failure of the market. It is the inevitable consequence of a system built on hyperbolic discounting and herd behavior. The disciplined investor must train themselves to resist these powerful psychological pulls. They must learn to ignore the noise of the crowd and the seductive allure of the short term. They must in essence learn to be a contrarian not just in their actions, but in their very time frame. While the herd is thinking about the next quarter, the true investor is thinking about the next decade. How can an investor protect themselves from the next chainsaw Al? How can you distinguish between a company with genuine sustainable growth and one that is simply playing accounting games? You need to develop a new skill, the ability to read financial statements like a forensic accountant. You need a mental model I call the sustainable earnings filter. This is a 5-point checklist to help you spot the red flags of financial chicanery. First, and most importantly, you must compare cash flow from operations with net income. You can find both of these numbers on the company's financial statements. Net income or profit is an accounting opinion. It can be manipulated with a wide variety of assumptions and tricks. Cash flow, on the other hand, is a fact. It's the cold, hard cash that is actually flowing into or out of the company's bank account. A healthy, growing company should have cash flow that is roughly equal to or greater than its reported net income. If you see a company that is consistently reporting strong profits but its operating cash flow is weak or negative, that is the single biggest red flag in all of finance. It means the reported profits aren't real, they aren't being backed by actual cash. This was the signature move of Enron. Second, analyze the days sales outstanding, or DSO. This metric tells you, on average, how many days it takes for a company to collect payment from its customers after a sale is made. You want to see a DSO that is stable or declining. If you see a company's DSO growing much faster than its sales, it can be a warning sign of channel stuffing. The company is pushing product onto its distributors and booking the revenue, but it's not actually getting paid in a timely manner because the distributors can't sell the product to end customers. Third, be wary of pro forma or adjusted earnings. Many companies, especially in the tech sector, will report two sets of earnings: their official earnings, calculated according to generally accepted accounting principles, GAAP, and their own custom-made pro forma earnings. These adjusted earnings conveniently exclude a long list of real expenses, like stock-based compensation or restructuring charges. When a company constantly tries to direct your attention to its own made-up version of profits, you should ask yourself, what are they trying to hide? The gap between GAAP earnings and pro forma earnings is often the gap between reality and fantasy. Fourth, scrutinize acquisition-fueled growth. Some companies grow not by selling more of their own products, but by constantly buying other companies. While smart acquisitions can be a great way to create value, a pattern of serial debt-fueled acquisitions can also be a way to mask a deteriorating core business. Companies like Valiant used acquisitions to buy revenue streams and use creative accounting to generate the illusion of growth, while their underlying business model was a hollow shell. Always separate a company's organic growth from its acquired growth. Finally, you must learn to read the footnotes. The footnotes to the financial statements are the boring, small print section at the back of the annual report that most investors skip. This is a huge mistake. The footnotes are where companies are legally required to disclose the details behind the numbers. This is where you will find information about changes in accounting assumptions, off-balance sheet liabilities, and transactions with related parties. Learning to read the footnotes is like learning to see in the dark. It is where the secrets are buried, and it is the ultimate tool for the disciplined investor performing their due diligence. The antithesis of this disciplined forensic approach is the quote-at-any-cost fallacy. This is a mindset particularly prevalent during bull markets and in hot sectors like technology or biotechnology, where investors become so fixated on top-line revenue growth that they willingly ignore every other aspect of the business. They will forgive enormous cash burn, non-existent profits, questionable ethics, and weak corporate governance, as long as the revenue growth rate is high and accelerating. The underlying belief is that if a company can just get big enough, fast enough, it will eventually achieve escape velocity. Scale, they believe, will solve all problems. It will lead to a dominant market position, which will then allow the company to raise prices and finally become profitable. This mindset is what fueled the dot-com bubble of the late 1990s, and it reappears in every market cycle. It leads investors to pour money into companies that have no viable path to ever making money. They are not investing in a business, they are speculating on a concept, a story. They ignore the most fundamental question of all. Does this company have a sustainable competitive advantage that will allow it to generate cash for its owners over the long term? This fallacy is dangerous because it feels right. Growth is exciting. It's easy to get swept up in the story of a disruptive company that is changing the world. It is much harder and much less exciting to do the boring work of analyzing cash flows and reading footnotes. The growth-at-any-cost investor is essentially playing a game of musical chairs. They hope to ride the momentum and sell to an even greater fool before the music stops. But when the growth inevitably slows, or when the market's mood shifts from greed to fear, the fall is brutal. Companies that were once valued at tens of billions of dollars are revealed to be worth little more than their office furniture. The growth-at-any-cost fallacy is a rejection of the core principles of value investing. It is a bet on narrative over numbers, on momentum over fundamentals. And while it may work for a while, it is a strategy that, over the long term, is a reliable path to avoiding financial freedom. The direct financial connection between these accounting shortcuts and a stock going to zero is the creation of an accounting house of cards. Each act of financial manipulation is like pulling a single card from the bottom of the deck to place it on top, making the tower look taller and more impressive. Channel stuffing inflates current revenue and accounts receivable, but it does so by stealing from future quarters, leaving a hole that will have to be filled. Aggressive revenue recognition, like booking revenue for a long-term contract all at once, makes the present look fantastic at the expense of the future. Capitalizing expenses that should be running through the income statement, like marketing or R&D costs, makes current profits look higher by pushing costs onto the balance sheet, where they sit as a ticking time bomb. Each of these tricks makes the current quarter's report look better. But they create a terrible addiction. To maintain the illusion of growth, the company has to cheat by a little bit more every single quarter. The $10 million hole you created last quarter now requires a $15 million trick this quarter just to show growth. This creates a voracious need for ever more creative and aggressive accounting. the balance sheet becomes more and more fragile, bloated with uncollectible receivables and questionable assets. The gap between reported earnings and actual cash flow widens into a chasm. Eventually, the company runs out of tricks. There are no more future sales to pull forward, no more expenses to capitalize. At this point, the entire house of cards collapses. The market suddenly realizes that the past years of spectacular growth were a complete fiction. The earnings were never real. The assets on the balance sheet are worthless. The stock price doesn't just decline, it plummets towards zero, because the company's entire reported history is revealed to be a lie. This is the mechanism of permanent capital loss. It's not a gradual decline, it's a catastrophic event, a sudden phase transition from perceived value to actual worthlessness. And it is the inevitable endgame for any company that chooses the path of the shortcut over the path of integrity. The ultimate goal of this entire framework is to construct a portfolio that is not just profitable but also resilient. It is to build an asymmetric portfolio, one where the potential downside is structurally limited, while the potential upside remains vast. This is achieved by systematically eliminating the single greatest risk, the risk of a company going to zero due to a catastrophic integrity failure. The foundational anecdote for this final pillar is not a story of avoiding a scandal, but of identifying and investing in an unbreakable reputational asset. It is the story of Buffett's landmark investment in the Coca-Cola Company in 1988. By the late 1980s, Coca-Cola was already a massive, mature company. Many on Wall Street thought its best growth days were behind it. But Buffett saw something that the spreadsheets couldn't capture. He saw a business that owned a piece of priceless real estate in the minds of billions of people around the world. For over a century, Coca-Cola had meticulously built a brand associated with the most powerful and universal human emotions: happiness, refreshment, togetherness, and nostalgia. This was not an accident. It was the result of 100 years of consistent, honest brand building, product quality, and brilliant marketing. Buffett understood that this mental real estate, this share of mind, was Coca-Cola's true uninsurable asset. It was a reputational moat of almost unimaginable width and depth. He knew that this moat gave the company incredible pricing power and a durable competitive advantage that no competitor could easily replicate. A new soda company could build factories and distribution networks, but it could not buy a century of accumulated trust and affection. He saw that even if the company had a bad quarter or a bad year, even if it made a product mistake like New Coke, the underlying power of the brand would protect its long-term earning power. The reservoir of goodwill was so deep that it could withstand almost any temporary setback. Based on this insight, Buffett invested over $1 billion, making Coca-Cola the largest single stock position in Berkshire Hathaway's portfolio. It was a massive, concentrated bet on the enduring economic power of a reputation for quality and trust. The investment was, of course, a spectacular success, becoming one of the cornerstones of Berkshire's wealth. The Coca-Cola story is the ultimate example of the offensive power of this philosophy. You don't just screen for integrity to avoid losers. You screen for it to identify the truly great, durable winners, the companies whose reputational moats are so strong that they can compound their earnings, and your wealth for decades to come, protected from the violent storms of the market. This idea of investing in durable, time-tested companies connects to a powerful mental model known as the Lindy effect. The Lindy effect, a concept popularized by the author Nassim Nicholas Taleb, proposes that for certain non-perishable things, like a technology, an idea, or a company, their future life expectancy is proportional to their current age. A Broadway play that has been running for 10 years has a higher probability of running for another 10 years than a play that just opened last week. A technology like written language, which has been around for thousands of years, is likely to be around for thousands more, whereas a new social media app might be gone by next year. The same principle can be applied to companies. A company like Coca-Cola or Procter & Gamble, which has survived and thrived for over a century, has demonstrated a remarkable degree of resilience. It has weathered world wars, economic depressions, technological shifts, and changing consumer tastes. This survival is not a matter of luck. It is evidence of an underlying robustness, an anti-fragility that is almost always built on a foundation of trust. Companies that cut corners, that cheat their customers, or that are built on unsustainable business models do not survive for 100 years. They are weeded out by the unforgiving process of market evolution. By focusing your investments on companies with long, proven track records of integrity and success, you are harnessing the statistical power of the Lindy effect. You are betting on the survivors. You are making a probabilistic judgment that a company that has demonstrated its trustworthiness for generations is more likely to continue to be trustworthy than a company with a short, unproven history. This is not a guarantee of success, but it is a powerful way to tilt the odds in your favor. It is the ultimate form of long-term investing, a strategy that replaces the frantic search for the next big thing with a patient reliance on the proven, time-tested power of durability. So how do we put all these pieces together to construct a portfolio? The final blueprint is a process I call integrity-first portfolio construction. It is a 5-step method that flips the traditional investment process on its head. Step 1 is to define your universe. Instead of starting with a screen for cheap stocks, you start by screening for durability. You create a potential list of companies that have been publicly traded for a significant period of time, say at least 10 or even 20 years. You might also add a screen for consistent profitability or a history of paying dividends. The goal is to immediately filter out the vast universe of unproven, speculative, and high-risk ventures and focus only on established, resilient businesses. Step 2 is to apply the negative filter. Now you take your list of durable companies and you ruthlessly apply the checklists we've developed. You use the sustainable earnings filter to eliminate any company with accounting red flags. You use the 3-bucket management audit to eliminate any company with a questionable CEO or a history of poor capital allocation. Be incredibly strict. Your goal here is not to find reasons to invest. It is to find reasons not to invest. As Buffett's partner Charlie Munger says, "All I want to know is where I'm going to die, so I'll never go there." This step is about identifying the places where your capital could die and avoiding them at all costs. Step 3 is to identify the reputational moats. From the much smaller list of companies that have survived your negative screen, you now switch to an offensive mindset. Your task is to identify the handful of businesses whose primary, enduring competitive advantage is their brand and the deep trust it engenders with customers. These are the Coca-Colas, the Johnson & Johnsons, the American Expresses of the world. You are looking for businesses whose value resides not just on their balance sheet, but in the minds of their customers. Step 4 is valuation as the final step. Notice what we haven't done yet. We haven't looked at the stock price. Only now, after a company has passed every single one of your qualitative filters for durability, integrity, and competitive advantage, do you begin the quantitative work of valuation. You can use whatever method you prefer. Discounted cash flow, price-to-earnings ratios, free cash flow yield. The specific method is less important than the principle. Valuation is the final gate, not the first. Most investors do the opposite. They look for statistically cheap stocks and then try to convince themselves that the business is good enough. You will do the reverse. You will find truly great, trustworthy businesses and then wait patiently for the market to offer you a fair or even a cheap price. Finally, step 5 is to concentrate and hold. Because you have done such an immense amount of qualitative due diligence, because you have such a deep understanding of the business and a profound trust in its management, you can have the confidence to reject the conventional wisdom of broad diversification. You can make larger, more concentrated bets on your highest conviction ideas. And you can hold these investments for the long term, through all the ups and downs of the market, allowing the power of compounding to work its magic. This is the path to building a truly robust, asymmetric, and ultimately life-changing portfolio. This integrity-first approach stands in stark opposition to the path followed by the 99% of retail investors, a path that can be called the diversification delusion. The average investor is taught that the key to safety is diversification. They are told to buy dozens or even hundreds of different stocks or to simply buy a broad market index fund. They believe that by spreading their bets widely, they are protecting themselves from risk. But in reality, they are often achieving the opposite. They are guaranteeing mediocre returns while remaining fully exposed to the very risks they fear most. This is diversification. When you buy a broad market index, you are buying everything. You are buying the high-integrity, durable companies like Apple and Microsoft. But you are also, by definition, buying the next Enron. You are buying the next Wells Fargo. You are buying the next Chainsaw Al Dunlap company on its way up, just before it collapses. You are diversifying away your ability to outperform, but you are not diversifying away the risk of a systemic integrity crisis. Your great picks are inevitably canceled out by the catastrophic blow-ups that you are forced to own. The integrity-first investor takes a different view. They understand that true safety does not come from owning a little bit of everything. It comes from owning a few things that you understand deeply and trust completely. They would rather own 5 companies that they have vetted through a rigorous integrity screen than 500 companies they know nothing about. Their portfolio is more concentrated, but their risk of permanent capital loss is, paradoxically, far lower. They have proactively removed the landmines from their portfolio. The diversification delusion is a comfortable lie. It tells you that you can achieve safety without doing the hard work of thinking. The path of integrity-first investing is harder. It requires patience, discipline, and a commitment to deep due diligence. But it is the only path that leads to true portfolio protection and the potential for extraordinary long-term returns. The ultimate financial connection, the mathematical proof of this entire philosophy, lies in the power of compounding without catastrophe. Let's imagine 2 investors, both starting with $100,000, who will invest for 30 years. Investor A follows the path of diversification. They buy a broad market index. Let's assume this portfolio earns a very respectable 10% per year on average. However, because their portfolio contains all the hidden landmines, let's also assume that once every 10 years, they suffer a catastrophic 50% loss when a major holding is revealed to be a fraud and goes to zero, dragging the whole market down with it. Investor B follows the integrity-first approach. Because they are so selective and value-conscious, their portfolio is more conservative. It earns a slightly lower average annual return of 8%. But because they have ruthlessly screened out the companies with questionable integrity, their portfolio never suffers a catastrophic 50% blow-up. Let's see what happens. In the first 9 years, Investor A, earning 10%, sees their $100,000 grow to about $235,000. Investor B, earning 8%, grows their capital to about $200,000. Investor A is feeling pretty smart, but then, in year 10, disaster strikes. Investor A's portfolio is cut in half, falling from $235,000 all the way down to about $118,000. In a single year, they have wiped out almost an entire decade of gains. Investor B, meanwhile, just keeps chugging along, their portfolio growing to $216,000. Now let's run this simulation forward for the full 30 years, with Investor A suffering another 50% loss in year 20 and year 30. The final result is not just surprising, it is staggering. After 30 years, Investor A, the one who earned a higher average annual return, ends up with approximately $245,000. A respectable but not life-changing result. Investor B, the one with the lower annual return but the greater resilience, ends up with over $1 million. That's more than 4 times the wealth. This simple mathematical example reveals the most important secret in all of investing. The avoidance of large losses is far more powerful than the pursuit of large gains. The brutal tyranny of compounding math means that a single 50% loss requires a 100% gain just to get back to even. These catastrophic events create holes in your financial journey that are almost impossible to climb out of. The single greatest determinant of your long-term wealth is not your ability to pick the next Amazon. It is your ability to ruthlessly avoid the next Enron. And the single greatest predictor of the next Enron is, and always will be, a fundamental lack of integrity at the heart of the business. Making integrity your non-negotiable number one investment criterion is not an act of morality. It is the most rational, most powerful, and most profitable financial decision you will ever make. You have just spent this time acquiring a powerful new tool, a new lens through which to see the world of business and finance. You have learned to look beyond the spreadsheet, to see that a company's reputation for integrity is its most critical, uninsurable asset. You now possess the framework to identify the subtle red flags of cultural rot and the hidden strengths of a culture of trust. This integrity lens is the ultimate form of risk management, a powerful shield that will protect your portfolio from the sudden, catastrophic collapses that wipe out the savings of the unprepared. You have taken a massive step toward transforming yourself from a speculator into a true business owner. But it is crucial to understand that this powerful shield is just one piece of a larger, interconnected system of thought. The mental models that Warren Buffett has used to build his unparalleled fortune are like a network, each one supporting and strengthening the others. The integrity lens you've just mastered tells you, with great clarity, which businesses to avoid. It allows you to build a clean, pre-qualified universe of high-quality, trustworthy companies. But this raises the next critical question. From within this universe of good companies, how do you identify the truly great ones? And once you've identified a great company, how do you determine the right price to pay for it? Knowing what to avoid is a matter of survival, but knowing what to buy and when is the key to building extraordinary wealth. The video that is now appearing on your screen is the next piece of that map. It is the bridge that connects the qualitative world of integrity with the quantitative world of valuation. It is the link that transforms your shield into a sword. Think of what you've just learned as the foundation of a great fortress. But a fortress, no matter how strong, needs a watchtower to spot opportunities and a gate through which to bring in treasure. The principles in the next video are that watchtower and that gate. It will give you the tools to move from defense to offense, to take your universe of trustworthy companies and identify the specific opportunities that offer the greatest potential for long-term compounding. This is the missing link that connects a good company to a great investment. The journey to financial mastery is a step-by-step process of assembling a complete arsenal of mental tools. Some will take the powerful lesson of integrity and stop here, content with the protection it offers. But for those of you who are truly serious about building a complete system for financial independence, for those who see this not as a hobby but as the craft of a lifetime, the journey must continue. The next piece of the puzzle is right in front of you. The click you are about to make is not just to watch another video, it is a declaration. It is a commitment to continue your ascent, to complete your mental arsenal, and to master the entire system that has proven to be the most successful in the history of investing. Complete the next stage of your training. Click now